Damian Harrington, you are Head of Global Capital Markets and EMEA Research at Colliers. Thank you for joining us on BiTV.
My pleasure. Good to see you this morning.
It's a pleasure to have you with us. Thank you very much. Let's talk about the latest Global Investor Outlook report published by Colliers Capital Markets, which is based on more than 30 interviews with Colliers Capital Markets global and regional experts, as well as a survey of 750 plus investors, in which Colliers anticipates the process of stabilization of the global real estate market to take hold by mid-2023. What could this stabilization process entail for European commercial real estate markets?
Okay, I mean, it's about coming to terms with an awful lot that's happening in the world and an awful lot that's affecting the real estate market. I mean, it's primarily about the big change that we've seen in interest rates, which I believe was anticipated, but I think the shock and the speed at which it's changed is just caused a few shockwaves across the globe. But it's really coming to terms with three things. It's the impact of this on the capital side of the business, but it's not just this, it's the economic impact, and we're now starting to see that come through in the forecast in terms of how it's impacting you and I as individuals, as households, as much as businesses and companies. And it's also how it's impacting the operational side of the business, how you actually operate and manage an asset and the costs associated with it. So when you've got factors that are influencing all three things, that's quite a lot to come to terms with. And coming to terms with that, we believe in terms of what we've seen so far, in terms of the pricing adjustments that we've seen across markets globally and in Europe, suggests that, with 100 basis point shifts already, in some cases a little bit higher, 125 basis points, we are adjusting to a new norm of slightly higher interest rates. Now, the interest rates that we saw go up and the swap rates moving up in particular in September really were very elevated and represented a bit of panic and the risk around all of this across the markets. They've since stabilized. As inflation has started to stabilize, the cost of food and energy has started to come down, thankfully. Supply chains are starting to ease up a little bit. And they were the three big factors that were cited by investors as their major concerns. So with those things, not normalizing, but improving and getting better, interest rates and swap rates are moving into what will be hopefully more sustainable long-term norms. But it is still an adjustment from what we've been used to, even if it's just for a few years. And there's still that process that needs to be kind of worked through. But like I said, it's also coming to terms with the fact that we've got a weakening economy next year, certainly in Europe and North America. APAC looks a little bit more robust, certainly in pockets anyway. And then there's the operational side of managing assets, the cost of energy. How do you set your service charges, given that everything that's going on, there's just an awful lot to contend with. But provided we stick on the journey that we're on, we do think things will stabilize by mid-2023, when there's a bit more clarity and certainty as to where interest rates will be, and then things start to kind of fall more into place from there.
Okay, so it's about waiting for the new normal, if I can suggest. And one thing interesting in the report is that you indicate investors could find pockets of opportunity rather than widespread distress on the market. In Europe, where could these opportunities come from? Maybe more, either in terms of sectors, but also of strategies.
Yeah, I mean, it's a combination of the two, right? But I think there's some fairly obvious sources of opportunities that will come through, simply through your traditional fund termination. So close-end funds that are at the end of their life, and they may have already exercised their extension. They're going to have to sell, so they're going to put assets into the market. So that's going to be one source of opportunity. There's going to be opportunities coming from those that need refinancing. And particularly anybody that's bought in the last 3 to 5 years. It's not coming up immediately, but the sooner they try to set that and fix their pricing so they understand what their asset's going to look like going forwards, that's an opportunity more on the debt side. But what we are seeing is an increase in the volume of debt funds that are being raised globally and in Europe to take access the opportunities that are going to come across the capital stack. So that's another opportunity. And that capital side is going to be looking at project finance, providing that type of finance for the retrofitting or upgrading of assets, and that's clearly a big shift that's coming through. And that in itself, looking at the changes that we've seen in terms of the number of investors saying they've now got a set acquisition disposal strategy, which relates back to ESG and the kind of energy efficiency criteria of assets. 45% say they'll sell up to 20% of their assets in the next 5 years. So that again is another source of opportunities coming through. You've got the listed real estate market, which is trading at a discount to net asset value. In some parts of Europe, there's definitely going to be some opportunities that come through there, whether that's as an investor buying a bond that needs to be rolled over, that's currently available at very high yield, which is not going to be particularly sustainable, and turning that into equity, or simply just putting more equity or capital into listed real estate, in some cases possibly privatization, but also into some developers or platforms that need more equity to keep their kind of business operating. There'll be opportunities there. So there's lots, but it's about finding it and picking it and really being very strategic about who you're looking for, what's going to be coming up, and getting ahead of the game, because there's also an awful lot of money now that's being raised for opportunistic funds and strategies to try to take advantage of some of these opportunities that are coming up.
Interesting, because this crisis maybe distinguishes itself by not being a liquidity crisis like a prior crisis, maybe into 2008 or thing like that. As the year begin and we are still in an uncertain market environment, what will be the top priorities for real estate investors? You mentioned ESG, energy. I don't want to give you the answers, but what do you say as the top priorities for our listeners to keep in mind?
I mean, it depends which kind of side of the fence you're sitting on or what your position is. If you've just raised a lot of cash that you want to start spending, then what you're going to be looking for is very different to an investor who's managing a fund that's got a lot of assets that they simply need to stabilize. So for most, it's stabilizing the asset, making sure that the tenants who are in situ are happy, the rent roll's working, you've got some indexation or at least a cap and collar to capture some real growth in rents. And you've also got an asset that's either got a project plan and financing to upgrade a project or an asset to make it more energy efficient and compatible with what's going to be needed going forwards. So it's about stabilizing that and stabilizing those assets and really understanding what the costs are and what they will be going forwards. And I think for many, it's still a case of figuring that out. But if you raised a war chest of money, then you're going to be looking at who potentially investor-wise or fund-wise or asset-wise or even locationally wise, where there might be some sort of pockets of opportunity where there's been one of those other things I mentioned, driving potential to buy something.
Interesting. Thank you very much for this very useful and important insight in this, as I said, uncertain economic time. Thank you, Damian Harrington, and thank you all for joining us. See you soon on BiTV.